Hey everybody, today we're going to be talking about moving averages. I'm going to teach you how people trade both simple and exponential moving averages, and more importantly, how to calculate both. As always, you should not use an indicator unless you understand it and you can calculate it. So first off, what is a moving average? It's a very common technical indicator. Primarily does two things. It can help identify trending markets and reversing markets. It always has a lag and is reactive because it utilizes old information, and you can customize it to use however many periods that you want. I have some common periods on the screen here. At the end of the video, I will have a free tool with a demo that'll show you how to calculate it, and you can get your hands dirty and calculate it yourself. So what's a simple moving average? It's about as simple as it sounds. It's just the average price over the last X number of periods. So if you have a 20-day simple moving average, it's just the average price over the last 20 days. And the downside of a simple moving average, if you have that 20 days SMA, each day is weighted 5%. So 20 divided by 100, they're equally weighted in the simple moving average. So the day 20 days ago is just as important as the day that just happened. But it's even worse than that, because if you think about the SMA and how it rolls one day at a time, the last day is only in one SMA. It's in the most recent simple moving average. But if you have that 20-day SMA, that day 20 days ago, so almost 3 weeks ago, it is now embedded in 20 different SMAs. So that day is very powerful, whereas the most recent day is not very important in the SMA. So a solution to that is the exponential moving average that weights the most recent period a lot more. It's still laggy, it still is reactive, but not as bad. The first period of the sequence is the SMA, because you gotta have the first period before you can begin the exponential process. You can see the formula down below. It'll make a lot more sense once we dive into the free tool. So how do some people trade it? Now this is a very, very simple methodology here. So just keep that in mind. You have to combine this probably with multiple indicators and kind of put it in your entire mosaic of your trading philosophy. But one thing it does is identifies uptrends and downtrends. If the price is above a moving average, it's an uptrend. If the price is below a moving average, it's in a downtrend. This moving average may act as a support or resistance. Now what I just mentioned is very, very simple. A little bit more complex are crossovers, which primarily tries to spot trend reversals. So the first stage of a crossover is if the moving average crosses over price. This is the first step you're going to see, the first thing that's going to happen. That's the initial signal for a trend reversal. Now, if a shorter period moving average, maybe a 50-day moving average crosses over a longer term, a 200-day moving average, that's a confirmation of that trend reversal. So the first, it's going to cross over the price, and the second, you're going to have moving averages begin to cross over each other, and that's the confirmation. Here, if the shorter crosses above the longer, it's called the golden cross. If the shorter crosses below the longer, that is called the death cross. So shorter crosses above, golden cross, shorter crosses below, death cross. And the golden is a good thing, that's a bullish sign, and the death cross is a bearish. Most people look at the 50-day and 200-day, but again, moving averages are fully customizable. So when should you use EMAs or SMAs? Now this is my personal opinion. And I've seen this kind of play out amongst peers as well, but utilize SMAs for simpler strategies, like if you're just trying to find support or resistance, mainly because it's a behavioral bias here. The more people that see it, the more likely it's actually going to be respected. EMAs are a bit more complex, and frankly, EMAs are more accurate in terms of finding the true moving price. So if you want to identify reversals, if you want to use it in, say, the MACD does use exponential, but it's again customizable. You certainly want to use the EMA in that. So ribbons are probably the most complex use of a moving average. Here you chart out multiple moving averages of different lengths. So maybe a 5-day, 10-day, 20-day, 50-day, 100, 200-day, all on the same chart. You can use simple or exponential here. I generally prefer exponential, but that's up to you. And you're trying to look at how these moving averages are moving in relation to each other. So if the moving averages are converging, where you see that yellow arrow on the chart, that means there's a potential for a trend reversal. If the moving averages are pulling apart, then that is a confirmation that the trend is very strong. So what about some criticisms to a moving average? It's reactive, like I mentioned before. The most recent days were less represented in simple moving averages, and it's still probably not as represented in exponential, but a little bit better. It works better in trending markets, pretty poorly in choppy markets, and it's kind of arbitrary depending on how many periods you choose. There's some standard ones, but still it's kind of up to you. So how do you calculate it? I showed you guys some formulas, but I want to dive into it and show you guys exactly how to do it. Here's the link, or you can check the description. So let me pull up the simple tool. Here we go, right here. So if you're watching this, you already know what a moving average is, so we can dive right into how to calculate it. So here I'm doing the 20-day SMA, the 20-day EMA. I have a closing price of a stock for like 1,000 days, something like that. So it goes back pretty far. The periods could be anything. So I just label them 1, 2, 3, 4. These are technically days, but they can be whatever you'd like them to be. So the 20-day SMA is the simple moving average, is simply the average of the last 20 days price. You could see that C2 to C21. It's as simple as that. And you would just drag it down, and it's the same thing. But the key here is, if you look, C2 to C21. So when you move it down, it's C3 to C22. So you roll off the data point on the back end, and you add one more data point on the front end. So that kind of gives you the idea of the criticism that the most recent data point is only in one SMA, but when you go back further and further, in the 20 days ago is actually in 20 different SMAs. So what's the exponential? The exponential moves a lot faster. So first, let's talk about the multiplier. So the multiplier tells you up here in G3 how much weight is put on the most recent observation. Here it's 9.5. Now remember the SMA, it's 5% in all observations. So this is exactly why the EMA reacts a little bit faster. Now, if you remember in the video, I mentioned the very first period in the EMA is simply the SMA, because you need a data point. So that's why you see the C2 to C21. And then here you begin the exponential weighting process. So what you're doing here is you are looking at the new period, which is $123.75. You subtract it out by the last period EMA, which is the $113.92. You multiply that difference by the multiplier, the 9.5%, and then you add back in the last period EMA. And that gives your EMA, and then you can drag it down. Now, it's something to note that to get a true EMA, you need quite a few data points. So even though technically we have an EMA on the 21st data point here, which is the second data point in our series, it doesn't truly become an EMA until another 30, 40, 50 data points. It takes a while for the exponential process to kick in effect. So let's take a quick look at the charts. This is the 1,000 periods here. The blue is the price, then you see the moving averages moving along. They look like they're right on top of each other, which is not surprising. They're both 20-day moving averages. But if you zoom in to a specific point, you can actually see the yellow line reacting just a hair faster than the red line. That's because it's exponential. It's a little less reactive. Alright guys, so that wraps up my video. Please subscribe to my channel, like this video, comment, spread the word, whatever you'd like. I really appreciate it. Good luck trading out there. And now you know how to utilize one of the most common indicators to moving average. And now you might be able to combine them with some more advanced technical indicators.